Wednesday, the 11th of October. Index levels in Europe tell you absolutely nothing. Stocks go sideways. Below the surface, there is much movement. We will discuss that shortly. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So it's a single stock kind of a day, I think. It's not a stock market, it's a market of stocks. Single names matter. Index going nowhere. A lot of things going on at an index level, macro level. They're all kind of cancelling themselves out today in so many ways. But look below the surface and there's some really interesting trends. Volumes are okay today in Europe. Novo Nordisk rises by 4.88%. The reason for that, it has had to stop a kidney failure study that's being done with Ozempic early. That sounds like a bad thing. It's not a bad thing. It's a fantastic thing. This thing is meeting all its goals early. They've stopped the trial because of what is happening and the success that they're having with this drug, which seems to be multiplying the number of things it can treat right now. So Novo goes higher. If you're in the dialysis business, though, this is not good news. Look at Fresenius, down by 7.7% today. It was down a little bit more earlier on. It's these kinds of trends that are providing some really interesting single stock opportunities right now, Alex. At an index level, though, we go nowhere.
100%. Something I hardly say. You're totally right, Guy. And you can see that reflected here in the U.S. as well. The S&P is just up by about 0.3%. Let's look under the hood for a sec. Exxon is down by 4%. We're kind of just continuing to roll over here after it spends about $59.5 billion for Pioneer. Interestingly, one of the best performing stocks is Caesars. You wouldn't think that Caesars would be doing so well if we wound up seeing any kind of recession or a harder landing or a consumer rolling over. But there's a gaming expo happening in Las Vegas, and apparently analysts were really pumped about what Caesars said about Las Vegas, that it's still really moving, going all cylinders, etc. Again, that narrative doesn't really fit then when we talk to GMM CEO Raveen Gandhi, when we talk about maybe the economy having to slow. And speaking of, two-year yield up about 2 basis points. PPI comes in hotter, status quo, buy the long end, sell the short end, Guy.
Absolutely. But that's the macro story. I want to talk about the micro story. In order to get the market to move big in one direction, you need kind of the bulk of stocks, or at least the heavily weighted ones, to be moving in the same direction. We've seen it with tech stocks to a certain extent. But at the moment, everything is kind of cancelling it's sort of each other out. You get a big move that way, but then you get a big move that way. In aggregate, the market doesn't go anywhere. And this chart, I managed to conflate stock and chart there into an amazing new word, which I'm going to start using. This start really kind of shows that beautifully. Look at where correlations are. Correlations are well below the 5-year average, as you can see down here. Definitely in the sort of the bottom of the range. And that just tells you that individual stocks are kind of doing their own thing right now. And that means from an index level you get nothing, but within the market, within the sector story, Alex, you need to get a lot. There's a lot of opportunities in there. The problem is, though, that it's so whippy that it's really hard to latch onto one of those trends for long and make money off it.
Yep, and then you're kind of playing different trends. So I mentioned Exxon, talk about, say, M&A trends. Now there's going to be a race to be like, can we pick the next target, for example? Now Exxon CEO Darren Woods, Pioneer CEO Scott Sheffield, after their $60 billion deal announcement, I talked to them about potential consolidation.
Shell companies cannot survive on their own long term. They're going to have to merge up, consolidate, and be part of a diversified company is my general opinion. And this should happen over the next 5 years.
It's a fantastic interview. It just is emblematic of kind of the story we're trying to focus on today. And our question of the day, Alex, can you pick stocks in this market? Can we figure out some of these trends that are going to be lasting and long-lasting enough to be able to take advantage of them? Let's kick it around. Let's figure out what's happening here. Bloomberg's Justina Lee and Heather Burke from our MLive team join me here on set. The trend, Justina, at the moment is that single stocks are doing quite a lot, that they're bouncing around all over the place. And within the market, you're getting quite a lot of single stock volatility. But at an index level, you're not getting much volatility. So you kind of want to be long single stock vol and short index vol. Is this going to be the trend that persists for a while? And what would it take to change it?
Well, I think what would change that is if we see a pickup in macro volatility, like people getting worried about the economic themes that affect the entire market again. And I think that really is the question at the moment, because we've seen this big move down in bond yields for the past couple of sessions. And of course, that's driven by Fed officials coming out and saying that, okay, maybe we've done enough. But to what extent is that because we're meant to be worrying about the economy now? Because if recession risk is coming back to the horizon, I mean, that's something that could affect many different sectors at the same time.
I don't know. That sounds like Justina's saying the macro is still the thing. Heather, can macro be a thing? Like, can finally micro win and you can pick stocks and it's going to be okay for the end of the year?
I mean, I think September we saw such macro drivers as stocks, especially things like tech and bond proxies, really got hit by assets pricing in higher for longer. I think we've seen some easing in that, and you have more scope for single stock stories to come in. I think going into the earnings season, as we focus more on specific companies, you're going to see a lot more of that. And also, I think earnings are going to create a lot of winners and losers, and that dispersion is going to make people focus in on different single stocks.
The problem is, though, that at the moment these trends are so whippy. You get into what energy stocks were everybody hated them, then they loved them, then they hated them. You look at the trends that this Zimpex story is creating. Are these narratives long-lasting enough for people to invest in them, or is it simply you just got to be in and out day by day?
So I think the narrative that we're going to see persist in the next few weeks is weakness in the luxury sector. So luxury is kind of Europe's big answer to big tech, and it's still considered pretty pricey. And it was one of the best performing, but you had LVMH, big bellwether, come out and sales were a lot slow down, missed estimates, and that caused a huge sell-off across the sector today.
But is that something that's going to last? Is that now part of a trend? Is that so? Because if you're in the momentum business, if you're trying to invest rather than trade, can you?
I think we're going to see, if we have more disappointing reports like this from things like Hermes and the Gucci owner Kering in the next few weeks, I think that's going to be a persistent trend, especially if we continue to see yields pressuring what I would call high beta sectors, and also if we see more economic data that the consumer is slowing down. In luxury, we've seen it in China, in the U.S., we're seeing it in Europe. So that is one theme that I see persisting. But you're right, there is a lot of single stock stories that can be whippy. Luxury is one that I do see having sustainability through the earnings season.
So, Justina, when you pair that with an earnings season kicking off, and I'm just wondering how the macro overlay will affect sort of the bottom up and the micro. I mean, at some point it's going to be about companies being able to navigate the uncertainty, and that kind of wins more than how many more the ECB hikes go.
Yeah, I think the focus really here is, how resilient the economy and in particular consumers have been to kind of the raises in interest rate. I mean, we're kicking off, with the big banks over the next few sessions. And the focus here is like, oh, are we going to see more bad loans? I mean, how are they seeing consumers respond to tightening monetary policy? And I think what Heather was alluding to is that we're already seeing some weakness out of the luxury sector. And that can be pretty worrying given that has been pretty resilient kind of throughout the pandemic and after that, but they're definitely seeing weakness kind of out of the Chinese consumer, which is not bouncing back as much as they expected, and possibly, from the U.S. consumer as well. And I think that could be a worrying picture, given that I guess the bull case right now is that we're going to enter a period where there's less rate volatility, but we're also not in a recession just yet. So I think anything that kind of shakes up that narrative is going to be pretty detrimental.
Is it going to get more? At the moment, the majority of stocks are moving in different directions on a kind of daily basis. You're seeing within the market a lot of single stock volatility. What would it take to get the shift though? And I'm coming back to the original question. What would it take for everything to move in the same direction? Does it need to be a macro trend? Can it be an earnings trend? Can it be? I'm just wondering kind of how that process is going to work and how quickly it could unfold.
I think the macro trend is probably it. And I think kind of like a big question right now is because obviously when we're looking at indexes, a lot of it is driven by tech mega caps.
Yep.
And one thing I always find kind of funny is like kind of earlier this year when rates were going up, I mean, tech mega caps did very well, which is kind of weird because given their high valuations. But now that bond yields are coming down, they're still doing very well. Yeah. So it's like, are kind of those names, especially with the AI trend, are they completely kind of divorced from any sort of economic reality? And so I think that's going to be the big question, given that, I mean, most portfolios are now so heavily concentrated in these names.
Yep, and then you wind up having the end of year window dressing, which I realize it's early, but still. All right, Justina and Heather, thank you both very much. Justina Lee, Heather Berg from our MLive team. We appreciate it. So coming up, we're going to have more insight into the question of the day. Can you pick stocks in the market? We're going to talk to Mark Anderson, UBS co-head of Global Asset Allocation next. This is Bloomberg.
You have to look, I think, right now, longer term, into some of the areas that thematically are going to matter. I mean, you think about the energy transition, you think about what just happened in the energy patch with the merger, but if you also look longer term, there's a whole area there where people are talking about types of transitions, but you're still going to have a long tail on a lot of use of regular hydrocarbons. You're going to have LNG is going to become a bigger and bigger picture, and I think that if nothing else, some of the horrible things that have gone on in the last year reminds people that energy security is in fact a real thing.
Sarah Hunt, Alpine Woods portfolio manager, speaking to Alex and me in the last hour, talking about the fact there are trends, themes that you can pick stocks against that will last longer than kind of the 5 minutes we seem to be seeing in the markets right now. It takes us to our question of the day. Can you pick stocks in this market? Joining us now, Mark Anderson, UBS co-head of Global Asset Allocation. Mark, great to see you.
Thanks,
you are seeing a lot of whippiness. You're seeing a lot of movement in single stocks right now. Today, an example, Novo Nordisk and Fresenius. The problem is that some of these trends don't last long enough to latch onto. And I'm wondering, therefore, despite the volatility we're getting in single stocks, despite the movements, can you invest in those names right now and generate a decent return?
I think when we're looking at a day like today, Guy, where we're seeing within the same sector some names that are moving extraordinarily in one or the other direction, it does feel like we need to be very quick. There's very few lasting trends that we can hold on to. However, when we think about value creation for our clients, there's an element that goes into asset allocation, so more the macro trends, and then within the signal security selection, there is certainly value creation that can be done as well. But we think about this more of a tactical horizon, typically of 3 to 12 months. So as tempting as it might be to go in on a day like today and think you have to be day trading to actually create value, I do think that there's trends that last within companies, but also the broader economy that we can latch onto. And I do think that there might be some changes on the global economy around where the U.S. economy is going, where global central banks are headed, that are likely to lead us back to a bit more of a directional trend in broad markets as well.
All right, so it's still a macro world for you, Mark. I mean, you're cross assets, for sure. So it's still a macro versus micro. But what are some of the trends then that overlay your investment thesis?
So I think at the moment, one of the things that we're certainly seeing is that, one of the most obvious ones is certainly that we're going to see the peak of interest rates in a very, very short amount of time, in our opinion. And that's going to be one where we're going to see, I think, cut from a number of central banks next year. So that's going to be a major change in trend. We think it's going to provide opportunities both for fixed income investors, in particular, those that they're taking a bit of duration. It, of course, helps a little bit at times when we're seeing inflation rates coming down. I think we're going to see more of that tomorrow. If we look at something like 3 months annualized and core PC, we're not that far away from what the Fed is targeting. And actually, a number of Fed speakers have been out very recently to suggest that that trend is something we're going to see, at least suggesting that the tightening in financial conditions means that we're not likely to see a lot more hikes in the very short term. So that's one of the major trends for sure, yeah.
Mark, I hear what you're saying about rates, but in theory, longer end rates shouldn't be that sensitive to what the Fed does. The movement that we've seen recently is more structural. It's about long-term deficits. It's about what China is doing. It's about a whole range of other things. And we still don't know the answers to those questions. How can you be so sure that the 10-year, the 30-year are really going to come down, that their yields are really going to come down if the Fed starts to signal maybe it's done and maybe starts to talk about cuts?
No, that's a very valid point. So I'd say if you think very, very long-term duration, you have to think about some of those sensitivities. And I think deficits, in particular in places like the U.S., the rollover debt at yield levels that are much more significant, which is going to be a lot more of a burden on budgets going forward. That's something that needs to be penalized, and we're seeing term premiums in the market starting to come back towards what would appear to be more normal levels. So this one, I'm fully with you. But I think there's a sweet spot if you go into around sort of the 5 to 10 years where we're seeing a good amount of value. Still a very unlikely situation we'd see any sort of potential defaults, in particular when we're talking about countries like the U.S. And then at the same time, when we have trends both with inflation relatively clearly coming down, we saw it even with the strong payroll numbers, we saw average hourly earnings is coming down, so underlying inflation pressures is definitely easing. Mm-hmm. So with that coming down, we think growth slowing, we worry less about the term premium at that end of the curve.
So is that so then is that a signal to buy U.S. stocks, considering that on a relative basis, Europe is not in that same position, or you need to be neutral on equities then with that perspective?
I think that's a bit of a global phenomenon. We have tended to like bonds a bit more than equities. Equities more in a neutral position. And we've tended to tilt a little bit away from some of the more expensive stocks linked to US and technology, and thinking there would be catch-up potential in some places that are very unlike at the moment. That could be around the European consumer, where everybody's bashing on the European growth outlook. That's something that looks particularly cheap to us. There's also parts of emerging markets like India that has a very attractive growth story. And then I know you talked about energy before, but at a time where geopolitical risk is a bit back at the fore, we do like things that link to energy, be it around selling puts on Brent, buying the Norwegian kroner, energy equities as a potential as well. So that's ways to protecting portfolios in times of, I'd say, geopolitical concerns as well.
Is the rate of return on the kind of strategy that you're talking about, even over the next kind of 6 to 12 months, is it going to be in excess of 5%, Mark?
I'll be honest and say I do think so, and we think basically we have a key message saying that balance is back, and what we mean with that is that we think actually returns across both equities and bonds on a global basis is likely to prove attractive, and for investors that are looking at investment horizons of the next 6, 12, 18, 24 months, what have you, from the way that we construct portfolios and the way we're projecting returns, we do think that there is more value in some of these balanced portfolios, and we do think that diversification is back among some of the major asset classes. So that's a key recommendation of ours to our global wealth clients.
Mark, how much volatility do you think we're going to see? So I hear you that the macro is going to be the driver. It is still tricky, sort of asset allocation, and how do you do it, et cetera. What kind of volatility are you expecting as we head to the end of the year when getting a clean read is really tricky?
I do agree, and obviously the conventional wisdom, if you hear most people talking on this show or elsewhere, would be that volatility is high because there's always a lot of uncertainties that we have ahead of us. I would say I would have felt a lot more confident saying that volatility was going up if we were in an environment where inflation was not under control. With inflation under control and central banks more in our back in case we're seeing growth slow down as we are sort of anticipating, I think there's a little bit of a Fed put coming back and at least central banks that can react to negative news. So I'd say while we always think volatility is going higher, I'd say I would have expected to go much higher if we wouldn't have had inflation under control, if we wouldn't have had oil price at least easing off somewhat of the peak. So I think there is a reasonable way to think about both bonds and equity markets doing well as we look 3 to 6 months out here.
Hey, Mark, we really appreciate it. Thank you so much, Mark Anderson of UBS. We appreciate your time today. So coming up, let's get back to that single stock story. You got another use case for Ozempic. The diabetes and weight loss drug is shown to have success in treating kidney failure. Details of that next. This is Bloomberg. Dialysis service providers are falling today after a study that Ozempic is showing early signs of success in delaying the progression of kidney diseases in diabetes patients. And you can see that echoing right there in the stock market. Simone Foxman of Bloomberg joins us now. Okay, walk us through. What's going on? What's up with this? What are we learning?
So this is a phase 3 study of semaglutide. This is Ozempic, also the same chemical as Wegovy. But these patients, 3,500 patients, were administered this once per week of a pretty normal dose. And essentially what they were looking for is, does the administration of this drug delay the progression of heart disease? Does it delay things like people dying from renal failure or from cardiovascular disease associated with chronic kidney disease? And they specifically specifically studied patients that had type 2 diabetes and chronic kidney disease diagnosed already. And what we know is that the study was stopped because an independent committee said they'd already met some of the interim goals in terms of efficacy, which suggests that it was incredibly successful. We won't know the details until next year, first half of next year, but that's the overall finding.
So if you're in the dialysis business, what does this mean for you?
Okay, this is not good for the folks in the dialysis business. In the long term, certainly. In the near term, there's a bit more question marks. Ultimately, it means if you don't have people's chronic kidney disease progressing, more people won't necessarily need dialysis. Dialysis is a huge expenditure of time and energy. People have to go 3-4 times a week. They have to sit there for 4 hours at a time. Some people can do it at home, but it's still an enormous amount of time and money. So if you're in the business of providing dialysis, as the likes of Fresenius, DaVita, Baxter are, or equipment for that, it's really bad, and that's why we're seeing their shares fall. You know, if you're in the overall health business, it's a good thing because people aren't getting to these levels of disease that kill you, frankly.
Well, we've seen sort of warnings from like Walmart, ConAgra, sort of talking about the reaction of what these kind of drugs are going to do on their goods and their services. How does that conversation evolve when you layer this part in now?
I mean, this is what these drugs are supposed to do, ultimately, right? They're supposed to help people control their diabetes, and they're supposed to help people stop people from developing chronic kidney disease. So this isn't necessarily surprising from that end. I think what's surprising is going to be all the other things that could potentially be treated by these drugs for diabetes or for weight loss. Yes, we've heard from some retailers, we've heard from airlines or from analysts studying airlines about the potential to reduce fuel costs because people weigh less. There's also studies of things like sleep apnea that are going on. So this has a broad-based impact overall, the development of these GLP-1 drugs. We still have to see whether there are long-term negative implications of taking these drugs, and you have to take them for life. But this is clearly, you know, a panacea, I think, for this part of the health industry.
Simone, great stuff. It's amazing to see the share price reactions. Novo Nordisk up, Fresenius and the others down really hard. The impact that this drug, this stock is having at the moment, amazing to watch, and you wonder whether this is one of these long-term trends that we can latch onto. Quick look at the 52-week highs. We're coming into the end of the day. Time for last orders. Let's take a look at what we've got here. Shell's dipped a little bit since I put this board together, but still earlier hitting a 52-week high. This on a day, of course, when we see that Exxon Pioneer deal getting done and dusted. Great interview with Alex a little bit earlier on. Stellantis up by 1.85, 52-week high. Novartis, there's another drug stock doing well out of Europe, 52-week high. In the media sector, the gaming sector, Scout 24 up by 0.7%. We'll deal with some more details in a moment. The close is coming. This is Bloomberg. I'm actually struggling to come up with anything useful to say about what is happening at an index level here in Europe. London's absolutely flat. The DAX is pretty flat. CAC's off a little bit. I think that's largely LVMH. We saw those numbers this time yesterday. So at an index level, nothing to see here really. At a single stock, at a sector level, there are things that are happening. But let's talk through what has happened in terms of the session thus far. It is kind of slightly reflective of what we're seeing. We're not going to do that. You got a brief glimpse of it. We'll go back to this. There you go. As if by magic. 453. But look, really tight range. Really tight range. Nothing. We might as well just have skipped over it because I'm not sure it's actually instructive in telling us anything. The next board is. We just talked a little bit about it. I want to show you the gap between Novo Nordisk, the maker of Ozempic, and Fresenius, the huge dialysis business based here in Europe. One up by 5%, the other one down by 7%. This is really quite significant. Now, the dialysis business has already been impacted quite significantly already by the expectation that Ozempic and Wegovy, etc., are going to have a significant impact. So the fact that we're getting even a bigger move today on the back of this kidney failure finding just kind of speaks to the potential for ongoing damage. When are we going to see this all priced in? So that's one of the big trends today. LVMH, I mentioned it just a moment ago. The numbers were out kind of this time yesterday. They were weak. It has been an ongoing trend. The expectation was that we were going to see weak numbers, but maybe not this week. And it just speaks to this multipolar slowdown that we're seeing within the luxury story. China, the United States, and now Europe. And it's all kind of coming together. Do the strong get stronger in this? Maybe not. Do the strong get stronger relatively? I think that's the trend that everybody's watching out for here. So that's LVMH down quite heavily. So you've got two of the biggest stocks here in Europe. Look at the spread between them, Novo Nordisk and LVMH. Okay, that was today. Let's talk about tomorrow. UK GDP data. We're going to get the IEA oil report for Alex. We're going to get the BOE credit condition survey. I'm really going to pay attention to that one just to see what's happening within the economy. There are certainly signs within the UK economy which is doing better than anticipated, but there are certainly signs that we are seeing cracks in the credit story right now. ECB minutes, I think we weren't allowed to call them minutes. I think we call them accounts, but anyway, I think we're going to call them minutes. And then we get EasyJet sales and revenue. EasyJet's had a pretty tough day today. We've also got the Israeli situation. We've got the Luton situation evolving. But it's been a great summer, Alex. The question is, what does autumn, what does winter bring?
Yep, winter is coming. As we joke about, I'm not going over there to Europe again unless, the euro goes to 103. So we'll get to that in just a second, but there are some headlines here that are crossing about Activision and Microsoft. So it looks like the UK CMA, so the merger regulator, will approve this deal in the coming days. You got Activision Blizzard rising to about session highs, flipping into positive territory. Microsoft is up by about 0.7%. They made some tweaks to that Activision deal to avoid an EU probe, and it looks like the UK could approve that in the coming days. So let's get back to EasyJet and what we expect from those numbers. Joining us now is Alexander Patterson, a research analyst, transport and energy services analyst at Peel Hunt. He has a buy rating on the stock and a price target of 850 pence. All right, Alexander, winter's coming. What are we going to learn about demand?
Well, so far demand has been really very good indeed. It has been surprisingly strong, I think, to many, given that we've had difficult economic conditions in the UK. There's an element of pent-up demand because a lot of people couldn't get away during the pandemic. And I think also we've not had very good weather in Northern Europe, and that has stimulated demand, people looking to go to sunnier places to enjoy themselves.
Does that persist, though? Does that persist out of the summer? People have spent a lot of money this summer going on holiday. We are seeing a cost of living story that is persisting in the UK and elsewhere. What does the winter look like, Alexander, in terms of that demand story?
Well, I think winter should continue to look good. And so all of the updates that we've heard from EasyJet's competitors indicate demand continues to be robust. Forward bookings have been ahead of where they were last year, and that is even though there has been an increase in capacity. So capacity will be up about 10% over the winter, but people want to get away. They want to go to the Canary Islands. They want to go to, southern Greece. They want to go to sunny places, and I don't think that's going to change. They will make savings elsewhere to fund the holiday.
What's priced in based on that outlook in terms of the stock right now?
the stock is trading at about 9.5 times historic earnings, about 7 times forward. So I think the view is very pessimistic. It is expecting demand to weaken. It is expecting costs to go up, margins to come under pressure. And I think that is overly pessimistic. My sense is things are going to be better than that, and that we may be seeing some upgrades coming through as the year goes on.
This sector has been trading as a proxy for the oil price recently. Certainly as the oil price has gone up and down, the sector's moved quite violently. Is that wrong? Is that the right way to treat it or the wrong way to treat it?
Well, in the short term, airlines hedge in Europe, and so they have EasyJet. The last time they updated was about 40% hedged for the coming year and much more for the first half. The forward oil price isn't as high as the spot oil price. Many expect it to fall back again after the recent increase. And so I think really that it is wrong. Also that airlines like EasyJet have a relatively short booking window. Most of the sales are made, in sort of 3 to 6 months out, and so fares will increase, other charges will increase in order to mitigate that. So I think, realistically, again, the market's taking an overly pessimistic view. It can be better than this.
EasyJet does fly to Tel Aviv. What are you going to be curious to learn about the impact of the Israel-Hamas war?
They do. EasyJet suspended flights into Israel a couple of days ago, and I suspect that what we're going to hear is that that suspension will be extended. Unfortunately, it seems that Hamas has attacked the airport this afternoon, and my suspicion, therefore, is that the suspension is going to be quite a long one, because there may be damage to the airport, which means that aircraft can't fly there until that's repaired, and certainly until the current situation is a lot better than it is.
Yeah, I think we're just waiting for details as to the exact nature of what you're referring to, Alexander. Thank you very much indeed, Alexander Patterson, Research Analyst, Transport and Energy Services at Peel Hunt. We did see a British Airways flight having to turn around a little bit earlier on today and head back as a result of the events that Alexander's describing, though I haven't actually seen confirmation of what has been happening on the ground. Let's check where European stocks have settled. These are the final numbers, a fairly timid session at an index level, but below that index level, at a sector level, at a single stock level, there has been much movement. The Novo Nordisk story continues to have a big impact here in Europe, but LVMH down pretty hard today. That's what's impacted the Paris market, and that's why it's underperforming. Okay, coming up next, we're going to head to Marrakesh. The IMF World Bank meetings are underway. David Schwimmer, the CEO of the London Stock Exchange Group, will be joining us next. This is Bloomberg. Okay, I want to take you to Marrakesh. The IMF World Bank meetings are underway. Of course, that means that Francine Lacroix is there. She's joined now by David Schwimmer, the CEO of the London Stock Exchange Group. Francine, over to you.
Yeah, hi Guy. We're on the road again to try and follow the movers and shakers to try and figure out exactly what's on their radar and what they worry about in the next 12 months. So as you said,